Have you ever seen a strategy online with a 90% win rate and wonder, how is this not a money printer? Backtest can look amazing, but most lie to you. And if you don't know what to look for, you're trading a story, not a system. If you're new here, my name is Mark Anderson, construction worker turned 0DT hedge fund manager. I've sold over $50 million in 0DT premium across over 1,000 consecutive market days. And I've seen just about every type of backtest there is, the good, the bad, and the ones built to impress people on Discord. In this video, I'm breaking it down. Why most backtests give you a false sense of security, the red flags to look for before trusting the data, and how we run our own testing and the process of vetting a strategy to avoid these traps when trading in a fund. Let's dive in. Let's start with the basics. A backtest is simply testing how a strategy would have performed using historical data. It's hindsight. But here's the problem. Just because something worked in the past doesn't mean it'll work in the future. In fact, the more perfect a backtest looks, the more suspicious you should be. There are three main culprits to assess a sketchy backtest. 1. Overfitting. This is a big one. Most people overfit for performance, not consistency. They filter out the big losing trades, polish that equity curve, and delete anything that messes up their P&L. But that's not strategy design. That's storytelling. At our fund, we actually do overfit, but we overfit for low variance, not high returns. We want the smallest standard deviation of returns and the tightest probability cone of outcomes around our expected return, not just the tallest green light up and to the right. By prioritizing this, we ensure it's easy to know when we are off track and we can limit the damage to make it minimal, and it makes it easy to course correct and find the constraint causing that drawdown and lack of performance. Optimizing for lower standard deviations of returns make the most consistent backtest possible. Optimizing for the CAGR helps you justify large sizing and poor risk management habits. 2. Survivorship bias. If you're only testing the stuff that's worked since the most recent crash, you're ignoring everything that failed. A popular one I see is the 1-1-2 trade, where it won almost all of 2021 and all of 2023, and everyone said, well, I would have never traded it during the COVID crash and I would have avoided that big drawdown because I know better. And a lot of those people ended up blowing up in 2025 through the beginning of the year and all of the volatility. And that means that your performance is inflated because you made a choice in hindsight of how you would have reacted to adverse market conditions. 3. Recency bias. This one's subtle but dangerous. It's when traders build out strategies that work great on the most recent 1, 3, or 6 month periods, but completely break down in different market environments on longer testing timeframes. At the end of the day, market regimes change and we have no idea when those market regimes will change. And even if we did, we have absolutely zero chance of predicting when the new market regime will be priced in. For example, since 2020, we had a regime that was strong Fed, weak administration under the Biden administration, where the Fed's guidance had more of an effect on the market than the administration. It looks like now the regime has shifted, a weaker Fed and a stronger administration under Trump, where the administration's comments have more of an effect on the market than the Fed's comments. All I see is everyone curve fitting into what worked this last year or 6 months, where we literally have a data set of an administration leaving office and that was present in 2016 to 2020. Yet no one is looking into that regime for hints of when Trump was in office, but rather just fitting to what's happened over the last 6 months. You're not designing for the future. You're just chasing what worked last week. And markets don't reward repetition. They reward adaptation. How to spot a bad backtest. Here are the 5 red flags that tell you a backtest is probably lying to you. 1. Unrealistically high win rates or equity curves that look too smooth. This is always a red flag. I made a video on the core 4 that you can check out, and if someone tells you they've cracked the core 4, consistent profits, low drawdowns, low capital requirements, and high Sharpe, send it to me and I'll hire them. But seriously, trade-offs always exist. If the chart looks perfect, it's either a mirage or it'll be gone in a month. The higher the win rate, the more the entire trade can turn unprofitable for 1 or 2 additional losses in the data set. 2. Tiny sample size. If someone says this strategy wins 80% of the time, but only shows 10 trades, that's meaningless. If a strategy is infrequent, it's less believable. Strategies need frequency and scale to be trustworthy. We look for hundreds of trades across different market conditions. 3. No real slippage, commissions, or real-world friction cost. If your backtest assumes perfect fills and 0 delay, throw it away. No trade fills on the mid, some get skipped on entries, and when you're doing this 10 plus times a day, that friction can compound fast of a difference in $5 in real trading cost. Slippage is a cost, and it shows up everywhere. 4. Data mining with no forward testing. If the only thing they show is a beautiful historical curve, they never did a walk forward analysis or out of sample testing, that's not validation. It's still a hypothesis dressed up as a result. Or as Mike Tyson would say, everyone has a plan until they get punched in the mouth. 5. Strategies with crazy returns on capital that don't come from risk premium. If someone shows you 100+% annual return with minimal drawdowns, but they can't explain the risk that they're taking, that's not edge, that's exposure, wanting to be punished. If the return doesn't come from a known scalable risk premium, it's probably not real. Here's how we approach strategy development in my hedge fund. Step 1, robustness testing. We test across different market regimes, high vol, low vol, trending markets, choppy markets. If it only works in one condition or in 2020 or the last 6 months, it doesn't make the cut. Step 2, Monte Carlo simulations. We randomize trade sequence to understand the distribution of the outcomes. Can your strategy survive variance, or does one bad streak wipe out all your results? 3, walk forward and out of sample testing. We train the strategy on one time period and test it on a different, and keep an unseen period. This mimics how trades adapt in the real market, and it's the best way to avoid fooling yourself and following hindsight. 4, real-world execution assumptions and tolerances. We bake in slippage, latency, and delayed execution with actual tolerances, and then we add even more on top of that. For example, if our slippage assumption were to double, does that strategy remain profitable with a positive expected return over time? If it doesn't, that strategy gets flagged or tossed. You can't just assume fills are going to be perfect. That's how strategies die in live trading. Step 5, portfolio level analysis and risk-first design. Before we add a strategy, we stress test how it impacts the entire portfolio. We ask, can we hedge this risk off? And if we can't, what happens when similar trades cluster? Protect risk first, then put risk on. We don't just optimize for returns, we optimize for survivability. Backtesting is a tool, but like any tool, it's only as good as the way you use it. If you treat it like a slot machine where you randomly pull the handle until it spits out winning strategies, you're going to get hurt. But if you use it as part of a disciplined, skeptical process, it can give you real insight. So next time you see a strategy with a perfect equity curve, ask yourself, is this real or just a good story told in hindsight? Another tip to go by for your worst drawdown, it's always in front of you. Since we're using prior data, I can almost guarantee whatever your max drawdown is on your backtest, you will exceed that in the next 90 days. If you found this helpful, check out my video on the Core 4. I walk through a similar framework for vetting risk that most retail traders miss. And if you have any questions about your own strategies or want me to review a backtest you're considering, drop it in the comments below. Make sure to subscribe so you don't miss the next video. I'll see you guys in the next one.